Good morning, good afternoon, good evening, whichever time you're watching this video at this Agent Academy. And today we're going to do some analysis on BTC USD, and I'm going to talk about a certain model on this Euro USD. So if you're my viewer and you haven't subscribed, kindly do subscribe to this channel. Let's get to 1,000 subscribers. So straight to the charts. This is basically an extended session or an extended tutorial on marking ranges and the correct direction. So when I mark my direction, or when I do mark my ranges on the charts, I do use the higher time frame like the monthly. So on this BTC USD, we are going to mark our ranges from the monthly time frame. So when I go to the monthly time frame, this is the kind of price action that we do have on the monthly time frame. So I've already marked these kind of drawings. I don't know if I should take them out before we start our analysis, but should I? Okay, let me check something before I do take them out. Okay, that is it. Okay, well, so this is what we are going to do. Let's actually use the drawings, so let's analyze the market while the drawings are still on the charts. So this is it. This is the monthly chart on BTC USD. So when you start to mark your ranges, remember which is the trend in these BTC USD. You can see it has been bullish. It has been bullish, really bullish, and then we've had this price declining from these levels, 120,000, and then it has declined to about 61. That is half of the price movement that it had made just on some few months ago. So what are you going to mark? Are we going to mark a bullish range or a bearish range? So basically we are on an uptrend, so what we should be marking, it's a bullish range. So where do you mark your bullish range, or how do you mark your bullish range? We can't mark this as a range. It is a typical range where we have a sweep at this point and a breakout at that point, but we are not going to mark that as a range, because if I go back to the candle chart, and if you've watched my videos, you know we have a liquidity just down below these points. Why is that? Because we have a fair value gap right here, and that fair value gap has been mitigated, and that mitigation gave us what? Gave us a breakout structure. So this becomes our liquidity zone. And liquidity, remember, liquidity is the magnet to price. So this is the liquidity that has been attracting this kind of price action, pushing it lower, dumping this Bitcoin to these levels, and actually below these levels. We are going to talk about that. So straight to the chart, let me just mark the ranges and then we continue. So which range do I see right here? This is the range. Right here we have a sweep. This is where we have a sweep. And then where do we have our breakout? At this point. So for the guys, okay, we have a sweep right here, and then this is our breakout, and then this becomes our what? Our strong low. So this is our strong low. And remember, for marking ranges, just to explain a bit for the guys who are new here, this is how we do mark a range. If you're marking a bullish range, this is what you need to mark. This, and then we'll have something of this sort. Yeah, we'll have something of this sort, and then taps into a key level, and then heads higher. So this is what we call a sweep of liquidity right here. This is a sweep of liquidity. This is where we have a sweep of liquidity. At that point, that is a sweep of liquidity, and then we have a breakout. So once you've had a sweep and a breakout, what do you mark? You mark your point of interest. Point of interest, you need to scale up one time frame higher to mark it. So if you scale up, remember we've marked our range on the monthly, so you need to scale up to the 3 months to mark your point of interest or your area of interest. So perhaps you've scaled up and then you found an area of interest, maybe an OCL or an MSNR key level, and then you're going to mark, and then you're going to anticipate that price is going to retrace to that level before it makes these actual move to take out this high. So this is what price has been doing right here. You can see we have a typical structure like this one, where we have a sweep, which is a typical sweep, right, like on this demonstration right here, and then we have a breakout. This is where we have a breakout. Now what we are going to do, you can see this kind of price action that is returning to this point is this. It tried to get back, but again price pushed higher. So this is liquidity, internal range liquidity. We're going to talk about that again. So this is the price that is going to come into a certain key level on the higher time frame before it heads higher, and then maybe it forms a new high perhaps in years to come. So on the 3 months, let's mark our point of interest. So I would have marked my point of interest. Remember, this is our strong low. So we have a lot, or we have several point of interest. Right here, you can see we have a bullish engulfing candlestick, and then we have this OCL as our point of interest. We also have this V level as our point of interest. Same case to this, we have this again bullish engulfing candlestick. Remember, that is a bullish order flow or a bullish indication that the market, we had more buys from this area. Then we have also this OCL. Why did I mark this level? Why did I mark this level as my point of interest? It's not that once price gets to this area, I'm going to buy. I'm not going to buy. I mean, this is my first initial target of this sell. So this is why you can see this was a resistance level. This is a resistance level at this point, an A level. This is an A level. Price rejected from that area, gave us a breakout structure to the downside, or gave us that sweep. Is the actually this is the rejection that gave us the sweep to our range. And what did price do? Price did close up, induce this zone, and then people could anticipate that price is going to sell from this zone. But what price did, it closed above it. Once it closed above it, it left behind what? An inducement, a liquidity. This is a liquidity. Why? We have this fair value gap right here. This is a fair value gap, and then we are anticipating that once a fair value gap has been mitigated and we have a break of structure, that fair value gap becomes our what? That fair value gap becomes our liquidity. That is the fair value gap entry model. Let me explain it again on this area using the very same chart, rather drawing demonstration right here. So this is the fair value gap entry model that I'm talking about. So let's assume price was giving us a series of what? Yeah, exactly. This is it. So we are on an uptrend, and price has been giving us what? A breakout structure to the upside. Yeah, for uptrend, so the breakout structure actually definitely have to be to the upside. So this is the breakout structure to the upside. Price has given us this breakout structure. Again, what does price do after giving us this breakout structure? In this price leg, price leaves behind what? A fair value gap. Assume price created a fair value gap inside this breakout structure at that point. So that is our fair value gap that price left behind before breaking structure. So this is our fair value gap. So on this model, actually this model now, I no longer call it the fair value gap entry model because I come up with it. So this is AJ model. Yeah. This AJ strategy rather. So once we've had a mitigation into the fair value gap, and you can see this mitigation, what did it do? Once price mitigated, this is the mitigation. This is where the mitigation happened, this price action. It mitigated this fair value gap and gave us what? Gave us another break of structure. Once it gave us another break of structure right here, this is the break of structure that price gave us. So we have our second break of structure. This is the second break of structure. Once price has mitigated a fair value gap and it proceeds to give you a break of structure, that mitigation becomes your liquidity. So we are going to mark that mitigation, this mitigation right here, as our what? As our liquidity. So this mitigation right here will be our liquidity, that mitigation. Let me have it that on the side. So that mitigation becomes our what? Our liquidity. This mitigation, it will become our liquidity. Where is my liquidity? Here, that is our liquidity. So what you need to do in this fair value gap model, you need to scale down, or rather you need to look at a key level, or observe or check for a key level just below the liquidity, just below, not below, just below the liquidity, and then you can take your trades from that area. So assuming you had a level right here, more maybe an OCL or maybe a QM, yeah, depending on which level has a it's immediately below or just below, not immediately below but just below. Remember, I'm using the just just below the liquidity, and then you can take now your trade. So this is what is going to happen. You can see we've had this is the structure, this is the basic fair value gap entry model. It's quite a powerful one. It has a good win rate. Yeah, my students can attest, or the people or the guys who are in my public channel, you can attest to this model if you've tried to backtest or forward test, or you actually used it to trade. So this is what we do have right here. I was explaining on the ranges. We had marked our sweep and then a breakout, and then I said we marked this area because of we had this fair value gap. This is the mitigation to the fair value gap right here. This is the fair value gap, that this break of structure, and then the fair value gap. We have mitigated that fair value gap. This fair value gap has given us what? A break of structure at this point. Simply same structure as this one. So what does this become? Our liquidity. This is our liquidity, which is the most immediate, or the level just below that. We have this resistance becoming support, or rather also you can refine to this OCL depending. So we are not going to take direct trades from this. We are going to wait for a reaction from that level, and I'm going to explain how you're going to take a trade, or you're going to take confirmation entries. So that is what we are anticipating, that this pair on BTC USD, it's going to get to these levels. Actually, it's going to sell towards these 46 to 11 levels before we have a reaction buyers coming into the market and then trying to push price higher. But before that, what again can we see on the monthly time frame? So we can actually mark as well our counter range. Where is our counter range? This is our counter range, where we have a sweep to the upside, and then we have a breakout at this point. It's clear on the line chart, a sweep and then a breakout. We've marked that, and then this is not our strong high, but this is the high of the range. Now we have this range. This is the range that you're going to trade on BTC, on this BTC USD. So now this is the range that we are going to focus on. So whatever price is doing right here, this all price action, it's a corrective move to a certain point of interest, so that we can start buying again to join the actual trend, which is bullish. So having understood that, now we are going to see, remember that is the logic behind this kind of price action that has been printing in the market. So now let's go and check how we could have been trading these kind of markets, here. So you can see, observing from this point, we have this level, which is a MSNR key level, which is a what? It is a support. Why is it a support? Why is it a support? This is a V level, basically a support, and then it has been rejected. It has been used as a support at this weak rejection. Price rejected from that level, but failed to push price higher, and then price closed below that level with a body candle closure. So that support becomes a what? It becomes a resistance, because support broken becomes a resistance. And then when it became our resistance, where did we have a rejection from that level? This is the rejection that we had. Remember, this is a broken support, and then this is the rejection from that support area. We had this kind of rejection, which was a sniper. Had you checked the price action on this very day, this was just last month price action, you could have taken trades, and then if you're a swing trader, you could have actually secured some good number of pips, or a good RR, risk to reward. Yeah. So this is where we have price rejected. Now, after having price rejecting from a higher time frame key level, like the monthly, remember price now is coming from the monthly time frame. So I actually developed a theory around this kind of rejection from a higher time frame, and this is very new. I guess this is the first time on this video I'm going to teach, or I'm going to talk about this kind of model that I came up with just a few days ago. I'm going to do a refinement of it, and then we are going to see how it plays out. So this is the model. Let me demonstrate it right here. So I'm going to use a bearish example to explain that. Now we have a bearish price action, where we are forming a series of, for the guys who understand SMC, the smart money concepts, you understand that on bearish we form a series of lower lows, lower lows, lower highs, lower lows, lower highs, lower lows, lower lows, lower highs, and that, yeah, continuously we are forming these kind of structures. Breaking structure to the downside, breaking structure right here to the downside, and then breaking structure to the downside. Now what does happen when we have this kind of price action, and then price comes out, takes out this? Some guys can call this as what? A market structure shift. Right here, once we've had this break of structure, then this kind of shift, people can call it a market structure shift. But remember, even using this kind of a value gap entry model, you can understand that this is liquidity that is being taken before the market actually makes now a massive move. So there is a level. Okay, let me have that. Let me have it at this point, and then so now price has done this kind of, this is a trap to the smart money traders who mark this as a breakout structure and then this as a market structure shift. So so this is what we are going to do. Rather than marking this as our market structure shift, you're going to observe where is this price. You're going to wait for this buy or this counter trend to react from a certain key level. You're going to mark your bearish order flow. So some of the bearish order flow, it can be this zone, this can be your, this right here can be your, this right here can be your point of interest. These yeah, these are the bearish order flows where price might actually use these levels, the 3 levels, to sell. So you're going to mark them all and wait for price to react from those levels. So what are we going to do? Now price has reacted from a certain level. Let's assume a price reacted from this level. Assuming you had a good A level at that point, that is a level, it's basically a resistance level. So price has reacted from that level. What you're going to do now, this is where I developed this model. This is actually AJ strategy. Now whenever you use it, yeah, just say I'm using the AJ strategy. So now this is the AJ strategy. Price has reacted from this point of interest, and then now how are you going to trade this kind of price action? Are you going to trade this price this kind of price action? You're not going to take a direct trade from that level. So what you're going to do, you're going to wait for this kind of price action to occur. So this is what I'm trying to explain. I'm going to do a practical example so that you can understand better. So this is what, once price has reacted from that key level, you're going to wait for something of this sort. Price to react, price to react from that level, and then gives you a what? A break of structure. Now, okay, what I failed, okay, before that, let me take that out. So before this, we could have had something of this sort before heading to our point of interest. Now this way. So this is the price action before this is what happened after tapping into our key level. So what you're going to wait on this model, so be keen on this, because now this is the best part of this strategy, AJ strategy. So this is what you are going to wait for, a reaction from that key level to take out the recent low that was formed, or the recent swing low or high, depending on the direction of the market. So for this case, this is the recent swing low. Once it takes it out, you're going to wait for another break of structure. Now this is what I came up with. This is the model I came up with, in the sense the first low, the first swing low to be taken out, we are going to call that low as a BBOS. This we are going to call it as a B, and then BOS. This is a break of structure. Understand that well, get that right. This is a BBOS. It's not a break of structure, it's a BBOS. It's a break of structure, because price is coming from a higher time frame key level and it has taken out a swing low. So this becomes our BBOS. In simple terms, or rather that is an abbreviation, this is a break of structure. Now you wait for price to give you another break of structure. Now this is what we call a break of structure. Now this is the typical break of structure that you know. So I want you guys to be marking that. This is a BOS, and then you need to wait for a break of structure. Now once you've waited for this break of structure, now you're going to take your knowledge of this fair value gap entry model to incorporate to this strategy and use it interchangeably together to actually get a trade. Now this is what I mean by saying that once you've had this second break of structure, this is the break of structure, or this is the price leg that we are actually going to use to mark our key level, our point of interest. And which strategy are we going to use? We are going to use this fair value gap entry model. We are going to wait for price to tap into a certain fair value gap inside this on a lower time frame, and then that fair value gap mitigation gives us a break of structure, another break of structure. It can be internal break of structure or external break of structure, and then that mitigation of that fair value gap becomes our what? Becomes our liquidity. So we are going to wait for that liquidity to be taken out, and then we take a trade. So this is what I mean by saying so. So assuming now, not assuming, but let's take that a fair value gap was formed inside this price leg. What are you anticipating to do? What are you anticipating that price is going to do? Price is going to do this. Price inside, even inside. Now, for example, there is an inside liquidity where as this price was heading lower, as this price was actually heading lower, it gave you this kind of tap into a certain fair value gap, and then gave you a break of structure, continuing to this kind of price move, so that people don't confuse this with let's assume, yeah, we had this kind of what is it actually, let me move this up a bit, and then this right here. Okay, I guess it's snapping because of the magnet, but inside this level we had this kind of mitigation into a certain fair value gap inside this price leg, and then this fair value gap gave us an internal break of structure. It doesn't have to be internal, it can give us actually the external, but just I'm saying for these special cases where it gives you internal, so that you don't miss a trade waiting for a fair value gap to be external, but you had an internal break of structure that gave you that had mitigated a fair value gap. So once it mitigates, this point becomes your what? This point right here becomes your liquidity zone. So you're going to anticipate that price is going to do something of this sort. Price is going to retrace, or rather price is going to retrace, take out that liquidity before it makes this actual move to the downside, taking out these immediate lows. So this is what price, this is the model. And before we continue with this BTC USD, explaining this BTC USD right here, what happened on this case, let me explain a practical example on Euro USD, because Euro USD we had a nice kind of entry using the very same model that I've taught you guys. Yeah, this one, let me have it right here so that we can refer back to it. So this is the model, AJ strategy model. So on the Euro USD, let's go to the daily and explain what I mean by that, or how that works. Remember the first thing that we said, price has to react or reject a higher time frame key level. So for this case on Euro USD, you can see price is rejecting from what? This failed support level. So these are support level. It's a failed support level because price closed below it, and then we had this rejection. We said we are not going to take an immediate trade from that rejection. We are going to wait for this kind of structure. Once price reacts from that level, we need to wait for the most immediate swing low to be taken out, and then after being taken out, we need to get a break of structure. Remember, this is a breakout. These are BBOS, and then we need to wait for a BOS. So on Euro USD right here, after having this rejection, we need to scale down. Remember the daily, most of you know that the daily aligns quite not perfectly well, but quite well with the 1 hour. So we are going to scale down to the 1 hour and see the price action that we had on the 1 hour. So on the 1 hour, you can see this is the rejection that we had from the daily time frame. So where is our BOS? The break of structure is at this point. This is the break of structure. It's at this point. So this is our first. Okay, let me label it. Label it rather. Label breakout structure. Now this is our. Actually, this is our B. It's our BBOS. It's our BBOS. And then for the second breakout structure, remember we've marked now. This is the first breakout structure that we've marked right here. BBOS. Now we need to mark what? We need to mark a breakout structure. Now let's go back to the chart. Where is our breakout structure? At this point, let me extend this. This is where we had a breakout structure. Remember, for a breakout structure, you need to have a candle closure below it. So this is a break of structure. Let me label it all the same. So this is a breakout structure. Now, after having our BBOS and a breakout structure, what did I say we should do? Going back to this, let's consult this. What do we need to find a fair value gap mitigation. We need to use the fair value gap entry model. We need to use this kind of entry model. We need to find a fair value gap that has been mitigated and given us a breakout structure. So that mitigation into a fair value gap is going to become our liquidity, and we're going to anticipate that price is going to retrace back, take that liquidity, and we use a key level just below that liquidity to have this kind of massive move. So that is it. That is why I said we need to have a mitigation into a breakout structure, a mitigation into a fair value gap. It gives us a breakout structure, whether internal or external. And then we are going to anticipate that price is going to come back to such to that area, take out that liquidity, and then sell to the downside. So that is what we are anticipating. Let's see on the charts if that is what happened. Now see, this is Euro USD. What has happened right here? We've had the second breakout structure after having the BBOS. Now the breakout structure. Now let's look, or let's find a level inside this area which had a fair value gap and a mitigation. On the 30 minutes, because on the 1 hour we couldn't mark a level, or we couldn't actually mark a fair value gap, so we have this fair value gap. I hope, let me zoom out. This is quite a good one. We have this fair value gap right here. This is the fair value gap that we had, and then you can see it was mitigated. This is the mitigation of that fair value gap. This is the mitigation, and that mitigation gave us what? This mitigation into this fair value gap gave us what? Gave us a breakout structure. If I go to the line chart, you can see that is the mitigation. It gave us a breakout structure. This breakout structure is internal. That's why I demonstrated so on this area. It might give you an internal breakout structure. So it's quite well again. So once you've had that kind of breakout structure, you need you mark that as your liquidity. So you are anticipating that price is going to come, take out that liquidity, and then start selling. So where is our liquidity? This is our liquidity. Where is our key level? Just above. We have this OCL. This is the OCL. This is the level that we're supposed to use to sell. But I did refine on the lower time frames, like the 15 and the 5 minutes. I don't want to go there because okay, I can't. Okay, yeah. Let's just. Yeah, you could have used, okay, even if you never refined and then you use this immediate OCL, you could have had just a drawdown of how many pips. Let me from that OCL, 1.6 pips. So you are quite in on the trade. So that is the trade. You can see we had quite a good trade using the very same model where you have a BBOS and then a breakout structure, and then you bring in the idea of fair value gap entry model, and then you take a good trade. It was quite a good trade. You can see, you can check right here. It was a 1:10 risk to reward. Let me compress this. And then for the second trade, same case, using the same model. Let me explain again. On the 4 hours, what do we see? We need to wait for price to react from a key level, to be rejected from a key level. Remember, we are doing this once you understand that the direction of the market is bearish. That's why we are doing, or we are marking this kind of trades, bearish setups. So you must align, you must mark these with alignment to the direction of the market. So right here we had this OCL. This OCL rejected, or price was rejected from this OCL. You can see this green, is it blue? The blue candle was rejected from this OCL. Once we've had that rejection, let's go to the 1 hour and see if we do have the BBOS and the BOS. So remember, this is the rejection. Where is our BBOS? This right here is our BBOS. That right there is our BBOS. And where do we have our break of structure? After having our BBOS, this is our break of structure at this point. I have a template of that. So this becomes our break of structure. This is our break of structure. And I said, once you've had a break of structure, what do? You need to find a key level in that price leg. So a key level inside this price leg on the 30 minutes or on the 15 minutes. So on the 30 minutes, what do we have? Right here, the 30 minutes, we have this fair value gap. What has happened to that fair value gap? It has been mitigated. This is the mitigation into that fair value gap right here. This becomes what? Our liquidity. Once it gives us what? Once it gives us a break of structure, you can see it had a mitigation and it gave us an internal break of structure right here. Mitigation, break of structure, a typical fair value gap entry model. So you should mark what? A level just above that point of interest, or a level just above that liquidity. Which level do we have above that point of interest, that liquidity? We have this OCL. You can see we marked the OCL and price came, mitigated that OCL, and we had this quite a nice, we had this nice sell. With that, we had this nice sell to this level. That is a 1:6 risk to reward ratio. But this trade, again, even if you could have used the basic AMD market structure, you could have gotten the idea to enter. You can see what this market did. It did a bit of you see, we were on a downtrend, we did an accumulation, and then price manipulated higher, then did what? We had a distribution. Yeah, we had a distribution right here. So accumulation, manipulation, distribution. So I've also done a video explaining these AMD models, so go watch my previous videos. And guys, if you're my viewer, remember to subscribe. Really do subscribe to the channel. So this is the second trade that this is the trade that we had using the very same model, this model. So coming back, let me go to the higher time frame again and see if we marked. Okay, now for this trade again. So for my mentees, they can attest that I did send this trade as well. This is a counter trade. This is a counter trade, so it's a risky trade, and I told them on my Telegram channel. I wish I could share the charts right here. The Telegram charts right here, but well, I can see we've had quite a retracement. I don't know why, but we are trading against the direction because we wanted to trade towards this level, this point of interest. And why are we trading towards this point of interest? Because we have price rejecting from this higher time frame key level. We've had a BBOS at this point, and then we have had a break of structure at this point. So we need to find a key level inside this break of structure. Remember, this is our BBOS, and then this is a break of structure. So where is our point of interest? You can see on the 30 minutes, we have this fair value gap. This fair value gap has had a mitigation. This mitigation becomes our what? Our liquidity. No, not break of structure. It's supposed to be a liquidity. Pardon. This mitigation into this fair value gap becomes our liquidity, which is our level that is just above that liquidity, is this level, because this liquidity mitigation gave us a break of structure at this point. And then also we have this Asian high liquidity at that point. So that is why we've marked this level as our potential sell zone. Once price gets to this level, we are going to sell towards these lows. But why for this trade? I mean, this is a counter trade. We are trading against the direction, so I wouldn't advise, but just to explain a little bit of what happened right here. We scaled up to the monthly. Okay, rather I scaled up to the monthly, and I saw price is reacting from a what? A monthly OCL. So we can't ignore the fact that price is reacting from a higher time frame. So what did I do? Once I saw price is reacting from a monthly, so I knew we are going to have quite considerable rejection towards a certain key level, sell key level, the sell order flow before we just push price low again. So this is what I saw on the 1 hour. On the 1 hour, you can see I checked in for the first BBOS, which is a simple break. This right here should be our BBOS. This right here, it's our BBOS. Where is our Now the break of, this, after having a BBS, we need to find a break of structure. This is the break of structure. Sorry. This is the break of structure. So we need to find a key level inside this level, a fair value gap entry model. So scaling down to the 15 minutes, we saw this. This is the mitigation into this fair value gap. This becomes our liquidity right here. This is a liquidity. And then which level is just below that liquidity? We have this level right here, a resistance level that had been rejected multiple times, and then price came, reacted from it. Now we are targeting this liquidity zone above right here. I don't know why price is sort of retracing back to our entries, although this trade it's quite a risky trade because we are trading against the trend. So I haven't really done due analysis of if this AJ strategy does work with counter trends, but we are going to see. We are going to do an observation, and then for the guys who are in my channel, we're going to do a recap of this trade during our free Google Meets that we'll be having here. So that is it, and that is how this AJ strategy, actually, this is AJ strategy now. Henceforth, this is AJ. Let me have it in caps. This is AJ strategy. This is AJ strategy. Yeah, it's it has the BBOS and then the break of structure. Just go rewatch this video and do your analysis, backtest, forward test. It actually works like magic. So we were right here. I hope I haven't lost you. Remember, we were doing BTC USD, and we had gotten to a point where we said price had actually reacted from this level. Once price reacts from a key level, now I think we've done the best textbook things that we need to have a checklist on. We need to have a BBOS and then a break of structure, and then we can use the fair value gap entry model to enter this kind of trade. So let's do this. On the weekly, okay, this is the monthly, rejecting monthly. Now we need to scale down to a lower time frame to check for those BBOS and then the BOS. So at this point on the line chart, it's very clear we have a what? A BBOS, a BBOS at this point, and then we have a break of structure at this point. So we are going to use this level as our what? Find a key level inside this area and then continue with the sales towards this level. So this BTC is going to have actually massive drops once it taps into a good key level, and then we are going to have drops until 46, and perhaps we can even close below 46k. So this is what we do, or this is what we saw on the daily, on the same daily, or daily or weekly. Let me check monthly. Well, yeah, daily. So on the daily, I think this is not aligning because of the refinement I've done. So on the daily, what you can say right here, we've had what? Let me go to the fours. I'm trying to figure out. Yeah, exactly, on the fours. So on the fours, this is still the weekly level that is being rejected. So where is our first break of structure? Where is our first break of structure from this area? So I didn't mark it because okay, this is a rejection. We have this BBOS right here. That's the BBOS, and then where is our break of structure now? Right here. This is our break of structure. Okay, if I go to the line chart, it's clearly okay. Yeah, it's up here. So we have this first break of structure because remember the BBOS has to take the most recent swing low. So this way it did take the swing low, and then where we had our break of structure is this. So we need to find a key level inside this level to take our sells. So which level did we actually see inside that? So right here we had this fair value gap right here, fair value gap, and then this is our liquidity. Why is it our liquidity? Because once it mitigated this fair value gap, it gave us a what? A break of structure. You can see we have a tiny break of structure at that level. So we are anticipating that this liquidity is going to be taken out. Let me have it so that my charts can't be messy. This liquidity is going to be taken out and price is going to tap into a certain level. before it sells, which level did price tap into this OCL right here. Let me have it at that OCL. So you can see, and we've had a massive sell from that level. We have had quite a massive sell from that level, because price tap into, we have this fair value gap entry model and that. So as well, this is more of the one that we've marked, this mitigation right here. If you check clearly, we are on the 4 hours, and this is more likely an internal structure. But where is our external structure? This is the external structure right here. Can you see this model where we have this? We've marked this as our first BBOS, and then again second breakout structure. So we need to find a key level inside this second breakout structure, and that's why we are having this corrective move. Where is our breakout structure? Where is our key level inside this? Remember, this is our first BBOS, and then this is the second breakout structure. So we need to find a key level inside this. Where is our liquidity? This is the fair value gap that we do have. After having this fair value gap, what do we need to mark? We need to mark a mitigation into the fair value gap. This is the mitigation into that fair value gap at this point, and then this mitigation is given as what? Is given as a breakout structure. So we are anticipating that price is going to take out this liquidity, tap into a key level. So this is a refinement I've made into this area, I think on the 2 hours, on the 1 hour. I think the 1 hour actually. Yeah, this is the 1 hour. And why did I not maybe take a level, the most immediate level, or just above, like this OCL? Why did I not take this OCL as my point of interest, and rather I took the extreme level, the A level, at this point as my point of interest? This is because on the 4 hours, I saw something on the old price action right here. Right here you can see we had this fair value gap, it had a mitigation, and on the 2 hours, that mitigation gave us a breakout structure. Where was that level? Okay, now again, let me go to the 4 hours and then line chart and then consult, so that I can mark exactly where was I referring to? Oh yeah, this area at this point. We had this mitigation, okay, let me have something marked so that once I scale down to the lower time frame, I can spot that. Yeah, right here we had this fair value gap, and then we had a mitigation. Once that mitigation happened, it gave us this breakout structure, this internal breakout structure. So we were anticipating that once price retraces into this level above it, it's going to sell, but price closed up above that level. So what we are anticipating is that price is going to use the very same level to sell from. So this is the first level, this is the level. So this is a bit of refinement into the lower time frames, like the 30. Yeah, it's quite a good level. On the 30, you can see again we have the extreme liquidity, where we have this tap into this small weak tap into that fair value gap. So this is what we are anticipating, or this is what we are anticipating on BTC USD. Price gets into this level and then we sell. We are going to have massive sells from that level. Mark these levels. This is which level? This is coordinates 64, 122, 72. That is a potential good sell zone. From that, we are going to have a crazy dump of BTC USD if at all price decides to hold onto our strategy. Remember, this is AJ strategy, and thank you all for watching. Do subscribe and see at the top. Join my public channel. It's free, and if you want personal mentorship, you can as well reach me via the my personal Telegram, not now the channel one, but use the other link, which is you can access to my own account. But for now, you can actually join the Telegram. I'll be offering some, once in a while, I'll be offering some free QA sessions on the meets. Bye bye and have a great time.